Hello there, I'm Joe Gordon with Gordon Asset Management, and here today to talk to you about performance in your 401k through the third quarter, with a brief update even through October 17th, which was yesterday's close. So obviously the news media is starting to cover that participants have lost a lot of money. It's estimated over $2 trillion in 401k losses year to date. And the average participant is down about 25%. So let's talk about what's happening, where the pain has been felt, and what you should do or consider doing. Again, these are our opinions, not giving investment advice. So first off, let's talk about U.S. stocks. U.S. stocks were carried by and large the last 5 to 8 years by the big tech names, the FANG acronym you've heard, that included Facebook, now they call themselves Meta, and Apple and Alphabet, which is Google, and Amazon, and so forth, and Netflix. So with all that said, those have really pared their losses this year. So when you look at growth investing, large growth, which has been the best place to be the last 5 years, you're down 29%, almost 30% year to date as of yesterday. If you invested in more conservative value stocks, you're down about 15% year to date. And these are from the Russell 1000 growth and Russell 1000 value indexes. Conversely, if you look at small cap investing, small cap growth down about 27% year to date, and small cap value down about 16%. So if you have more conservative view on how to invest in stocks, you've ridden a lot less down on the value side, but then it wasn't as exciting the last 5 years. So being diversified makes sense. Looking outside the U.S., what's happened? Well, the dollar's strong, and so all the international markets are not doing well. Typically, foreign investing works best in years when the dollar is receding or weakening, not going to some of its all-time highest strength. So international investing's been a loser, and it's really not been a good place to be the last 10 years, except for maybe 1 year in 2017. You could argue 2021 to some extent as well. And then let's talk about fixed income. Fixed income is having its worst year dating back to actually the year after the Depression, or the year of the Depression. And even balanced portfolios, people call them 60-40, 60 stocks, 40 bonds, are having their worst year since 1936. So there's been nowhere to run and hide this year except in cash. So if you're in a target date fund, for example, a do-it-for-me solution, you have an age-based asset allocation fund. And so if you've got 20 or more years until retirement, you should actually double down your investment until it hurts, because you're buying things on sale. If you can. Now, we understand people have tight budgets and maybe that's not possible, but that would be the best advice, because if you consider moving out of it now, you're basically already ridden 75 to 80% of the losses down. And all of this has been induced by the Fed deciding to be hawkish and tighten. So we've had essentially going from about zero bound interest rates to now 4%, and the Fed says they're tightening once more in November and December. That would take the 2-year Treasury rate north of 5% towards 5.5%. Again, people say history doesn't repeat itself, but it sure does rhyme. The current Fed chairman, Jay Powell, is somewhat mimicking Paul Volcker, who did this back in 1980. He raised rates in 6 months from 9% to 15%. I know for those that don't know their history, think that's probably, what, are you serious? How could rates be that high? Well, that's where they were, and we had this big inflation problem. So they're trying to kill inflation. Just be patient, be a long-term investor. Everything will work out. Stay tuned. We'll be back in touch next quarter.